And we're on the air. Hello, friends. Welcome to another Code Mentor office hours for today. My name is Mark. If this is your first time joining us, basically what we do is we get together online with some of our favorite tech and startup experts and leaders and just try to get a lot of clarity on different ideas or programming languages that we're interested in. And the past month or so, we've been really focused on very technical subjects. We've been focused on JavaScript and reactive, things like that. And today we're kind of going in a different direction. You know, the reason so many of us are in technology is we want to build projects, develop possibly even to full companies and really build things that reach people. And our today's guest is really focused on that part of the process. So before I introduce our guest, a little bit of housekeeping. If you're in the room with us, the live room with us, you can feel free to use the group chat to throw questions in. And if you're watching the live broadcast from the Google Plus page, there's a little Q&A app. It can be hard to find, but it's like neon colored. And I'll be getting questions via that. So feel free to throw questions in as we go. But without further ado, our guest today we're super excited about is David Cohen. David is the founder and managing partner of Techstars. For those of you not familiar, Techstars is a mentorship-driven seed accelerator based in Boulder, Colorado. Also has a bunch of locations around the world now. David's also an investor in companies like Uber, Twilio, SendGrid, and many more. And he's joining us today to really answer your questions. And you know, we thought to guide the line of questioning a little bit, we've decided that today's theme is what investors look for in startups. And along the way, we'll talk a bunch about Techstars as well. But David, welcome to Code Mentor Office Hours.
Thanks, Mark. Yeah, awesome to be here with everybody, and a huge fan of Code Mentor, obviously. I love how it helps people figure out how to get their stuff done more efficiently, and all the expertise that's out there that you're tapping into is awesome. Thanks for setting it up that I wasn't going to answer technical questions too deeply. I haven't done programming in about 15 years now. That was my college sort of focus, and I did a little programming out of school. But if it's going to get into Hadoop and stuff, I'm toast. So happy to talk about investing and that whole world.
Nice. Yeah, well, nothing's changed. It's still the exact same technology as 15 years. Cool. Well, I can kick stuff off with some questions that we had emailed in. But guys, again, the format of this is going to be a little different. So it's just going to be Q&A the whole time. So feel free to start throwing your questions in. I'll get us rolling. So to start off, obviously, everyone can read the official description of what Techstars is, but I wanted to take the opportunity, since we're speaking to the founder, to hear what Techstars is to you.
Sure, it's a lot of fun, right? I mean, I think when I started Techstars 8 years ago, I sat down like a lot of people do, and I had 10 different startup ideas, right? I was an entrepreneur previously. I had 3 of my own companies. I sold 2 of them. I was sort of dabbling in angel investing. I probably made a dozen angel investments, and I had all these different ideas. And I said, you know what? For the next phase of your life, like, you're lucky enough that you can kind of go do whatever you want. Just do what's fun, and you'll figure out the rest later. Do what you love, and that's why we started Techstars. The way we think about it is helping entrepreneurs be successful by building really a global ecosystem, right? That's what's different about Techstars is we have 2,000 mentors located in 15 different communities around the world. We run 18 accelerator programs a year. We surround that with about $300 million in venture capital, right, to follow on in those companies and invest in the ecosystem. But we're trying to build the best ecosystem in the world for entrepreneurs to bring new technologies to the market, right? So what does that mean? You get the expertise and the mentorship and the network. You get the capital. You get the partners, right? We'll partner with great organizations like Disney and Ford and Kaplan, all these great organizations. So we have just a huge network to bring to the table, and what we want to be is, when you think about starting a high-growth startup that's internet-focused, you think about Techstars no matter where you are in that journey.
Awesome. So between the time when you started doing angel investing and you were sort of wrapping up your own companies, I mean, was there a specific itch you wanted to scratch that you didn't see out there that made it really necessary to build an accelerator like this?
Yeah, there were 2, right? I mean, it was sort of dual motivation. One, from my perspective, having made a dozen or so angel investments, thanks for muting. Having made about a dozen angel investments, I basically thought, this sucks. Like, this is a great way to turn a large fortune into a small fortune, right? That's about all it is. what you're doing is you're meeting people in a coffee shop. They're pitching you their great idea. You're investing. You have nothing to do with the company, and you're just hoping it works. I wanted to professionalize the notion of angel investing. Let's get more time with these companies. Let's contribute our time and energy, not just our money, right? And let's organize and galvanize that idea around the world. And then from the other side, right, as an entrepreneur, sort of having been through it myself, I thought a little bit of capital is pretty easy to come by. It's not hard to save, 50 grand, 100 grand and start an internet business, right? I mean, hosting is cheap, right? A lot of us know how to write our own code these days. But what is hard is getting the experience and the network. I mean, surrounding yourself with people that understand what you're trying to do, have the connections, can help you avoid the pitfalls. I want to solve that problem too. And that's what we're trying to do as we scale up Techstars. Is really anybody out there with a dream and a vision and a purpose and an idea can leverage and tap into a network that can help them make that a reality.
Awesome. So, so that said, talk a little bit about maybe like the day in the life of a Techstars startup while they're in the program. What are the kind of perks and benefits that they get that others don't?
Sure. So it's a 3-month program. So just for context, people apply to Techstars. We get on average about 1,000 applications for 10 spots. So we accept about 1% of applicants. You can think about it like MIT or Harvard sort of acceptance rates, right? So we don't work with just anybody. We work with the most promising companies that apply. They get funding on the way in, so they get about $120,000 on the way in. We become an investor in the company at that point. When Techstars, that 3-month program starts, we think about that as high engagement with the mentor. So you're getting a lot of feedback on what it is you're doing. You're getting challenged and pushed, and it forces you to gain conviction about the direction the arrow is pointing before you step on the gas, right, and go the wrong direction. You build network and relationships so that in the 2nd and 3rd month, you can really focus on getting that product out there, using those mentors and that network to find your early customers, your early partners, your early users. The big fan base around Techstars is great for consumer companies because people want to try stuff. And then at the end, of course, there's demo day, which a lot of people sort of hear about, which is a chance to present and pitch what you're doing to investors. We typically get 500 to 1,000 investors to show up. Companies typically, on average, actually raise about $2 million post-program using those methods from the venture and angel community. And then they're sort of set free. We're not an incubator where we want to hold that company captive. We want them to live on their own and survive on their own, but continue to leverage the network. So people think of the accelerator as 3 months. Really, Techstars is for life. It's an alumni network that's extremely active. There's an annual thing called FounderCon that everybody comes back to that rotates around the world, different locations. Mentors come to that. They often have made lifelong lasting relationships with their mentors, the people that they've worked with in the program. Huge online community. The beautiful thing about all this is it becomes a self-sustaining network where the exited entrepreneurs are the new angel investors or the new VCs. They're the new corp dev contacts inside the companies that bought them. We've had 70 exits by M&A now, right? So we have a lot of that kind of virtuous cycle going on. So it is a lifelong experience that's very intense for those 3 months.
Awesome. So you mentioned consumer web as an example. I would assume that's probably the example that comes to mind for most people when they think of accelerators like you guys. Do you also have as many examples in other areas in enterprise software, but maybe they don't get covered as much?
Absolutely. A lot of our companies are focused on sort of B2B. Many are what you might consider enterprise, sort of larger ticket items. But as an example, DigitalOcean, right, is a company that sells to developers but also to businesses primarily. SendGrid, right, another example a lot of developers know about that's coming out of Techstars. They are obviously focused on the developer API-centric sale, but really their customer base is sort of corporate enterprise-level contracts. So you actually, the fascinating thing to me is that those lines are really blurring. I mean, the classic, sort of first example being Dropbox. Is that an enterprise company or a personal? Yeah, both, right? The model sort of stretches across all of that because of the utility of it. And that's true with a lot of our companies that end up growing and doing well.
Awesome. All right, well, I'm going to switch to some live questions popping in right now. So Garrett, who's in the room with us, I believe, how do you decide on which companies to join Techstars? Is it based on their code skills, size of team, if they're experienced, if it's a startup? Yeah, can you maybe just talk about the selection process a little bit?
Yeah, so as I said, we on average only select about 1% of applicants, so it's quite a lot of work, right, up front to filter the inbound interest. We really look for 6 things in order. We think about them very much in order. And so all of our managing directors that are out in the geographies and all of our 75 people in total really look at it the same way. We are looking for 6 things: team, market, progress, idea. Okay, so I deliberately say team 3 times because it's that important. These are startups. We're just really concerned with the talent of the team, the passion of the team, what's motivating the team, how the team knows each other. This is a people thing, right? It's startups. The founders are going to set the culture of the company. They're going to set the future vision. It's so important we say it 3 times. Really, really focused on that. So we can come back and talk about what that means in more depth. But market, right? It's a market that we're interested in. It's one that is either growing rapidly, shrinking and going away, but probably not stagnant, right? The innovation tends to happen in markets that are not already saturated with good technology, but in markets, like Uber, right, where this market was imbalanced, inappropriate, right, unequal. There were brokers taking 50% of the fees away from the drivers, 70% of the fees away from the drivers. That's a broken market where the value is not going to whoever's providing the service. The internet will not allow that to continue, right? It's the great equalizer. That is the thing that we were interested in that case, market. Progress, we have this theory that, and we're pretty sure it's right, that entrepreneurs actually do stuff. Right? They don't wait around to get permission to do stuff, right? So we look for people who actually run through walls and do stuff. They don't say, well, I need to hire a programmer. They start programming, right? Everlater, great example. 2 Wall Street guys wanted to create a travel blogging company. They just started creating it. It was terrible. It was awful. Horrible code, right? They knew it, but it had to come out of them, right? We look for people who are doing stuff and not just saying they want to be entrepreneurs. Which is called entrepreneurs. And then idea. I put idea there only because I like to show that it's last. Right? It's important, it's bonus points, but it's going to change a lot. We want to make sure that the founders are in love with the problem and not the solution. Right? So your idea is one example of attacking the problem that will probably change over time. The follow-up question for a lot of people that I'm happy to answer if you want, because I know it's been a long answer, is when you say people, right, team, what does that really mean? What do you look for in the team? So I'm happy to spend a minute or 2 on that if you'd like. Yeah, okay, so on the team, right, specifically, it's easy to say we want a great team, we want passionate people, and everybody raises their hand and says, I'm passionate, right? Of course you are, right? You wouldn't start a business if you weren't passionate. We want to understand the source of the passion. Okay, so we ask a lot of questions about why you're doing this, what's motivating, why did you not do the other thing, right? Like when I talked at the beginning, I had all these startup ideas and I wanted to do this. What was my passion motivator? Where is it coming from, right? And genuinely, I just wanted to help entrepreneurs because that was the most fun for me. I love the beginning of each of the other 3 startups I was involved in, and I didn't like the scaling phase. Right? I was the creator, the force that made it happen. I wasn't the operator that scaled it. And I knew that about myself. I'm looking for that in entrepreneurs we fund. You could tell, sorry to always go back to Uber, but in the angel round of Uber, there wasn't a car on the road, right? It was an idea. And it wasn't some famous founder from Silicon Valley, like the story goes today. Travis and Garrett weren't actually active yet. It was just Ryan, who was the only guy in the company. Right, the first employee and the only guy sort of fully active in the business. But I could feel in Ryan that he had a vision about how the world would be different. He was purpose-driven. He was mission-driven. He was going to make that thing happen, and he actually cared about it. It wasn't that he had done a spreadsheet to understand the opportunity and decided that this was the biggest opportunity. Nobody knew it would be this big, right? He genuinely envisioned the future and was going to, I could tell, work his butt off to make it happen. They had all the other stuff, raw talent. The guys were amazing that were involved. They had the technical skills. But what I look for is what's driving the fact that you want to do this particular business.
Awesome. Well, one thing I've learned actually from doing hosting a lot of these office hour sessions is I've learned about the Code Mentor community. We have a lot of, I guess, solopreneurs, right? A lot of people who they don't have their co-founder, they don't have a team, but they're working on something. They really think they have something. If given, I think you already covered the importance of team to get into something like Techstars. But what type of advice do you give to someone in that situation where they really have something, it's working, but they're really by themselves on it?
So there's a lot of mythology around the idea that accelerators don't like single-founder companies. I think Y Combinator has talked about this. We've talked about it. I don't know if others do, but I think that there's a misunderstanding, a misinterpretation of that data by a lot of people. I believe, and I think most people who've been through this a while believe, there's plenty of successful companies that are going to be started by single founders. Right? I can point to examples, RIM, BlackBerry, there's easy ones, right? There's also plenty of companies, by the way, that have multiple CEOs and not just one CEO that are successful. That's the beauty of entrepreneurship, is there's no rules. That said, I think a single founder in the context of Techstars is a very difficult proposition. You're being asked in 3 months to work with investors on your pitch, build the product, go to market, meet with all of these mentors. It's just sort of difficult to manage, right? You don't have the bandwidth to do it all. So Techstars is extremely demanding, right? And we found that startups, of course, are too, and having the emotional support inside the startup for inevitably when you want to go outside and punch something or kick something, to talk you off the ledge, and for them to have a high day when you have a low day, and to balance each other really matters. It matters a lot in the context of Techstars, which is a 3-month process where you're asked to do a lot. So we've only funded a single founder, say 2 or 3 times. Sometimes it's worked out just fine. Often it's because they had a big team that they were outsourcing to, and they were the single founder. But my advice is, in general, build a great team around you. Whether or not they're founders doesn't matter so much. The whole idea of Techstars is that you're building a great community around you. Do the same internally. And you'll find it's great for the emotional support. Most startups that are successful are multi-founder, that's a fact. But it's certainly possible to do it single founder, and we're not anti-single founder in any way. It just doesn't work for us in this context.
Awesome. Yeah, we got a bunch of questions about exactly that, so that was great. And I see a bunch of more people just joined in the other room. If you missed what I said at the beginning, there's a Q&A app in the Google Plus page. Feel free to send questions in. What questions do you like to ask entrepreneurs to try to separate them from the crowd? So I'm thinking maybe this is towards the end of the application. You've narrowed down the applications and you're meeting with people. What's the question that helps really segment the top people?
Well, aside from the one I talked about earlier, the source of passion, I really try to get into the why. We love to get companies in a room, or maybe 2 different rooms, and just say, what sucks about the other person. What drives you crazy about your co-founder, or what are they not good at? And it's actually really powerful when you do it in the same room, because I've found that the best entrepreneurs their relationship is strong enough where they can just talk about a thing they've already talked about. Right? So healthy dynamics. Look, team is almost everything, right? You got to have the talent. Those are table stakes. You got to have a great concept, right? But you can evolve it with the right team. And so we're probing for insecurities or misunderstandings in the team, because we want you to stay together and be committed to this thing. Most startups fail because teams just fall apart, right? There's 2 big reasons. Teams fall apart, or nobody wanted the thing you were building. And if it's because nobody wanted the thing you're building, you're just stupid, right? Like you're not listening to the market. Like you're just not a good entrepreneur, right? Because as long as you can stay alive, right, and listen, you should be able to evolve the thing to something somebody wants somewhere, right? And the team is what matters to make that happen. So that's why we're so focused on it. I think that question of, hey David, what do you not like about Mark? And I'd be like, I really think that his beard is not optimal or whatever. But it's something more substantive, right? But if you've never heard me say that before, it's awkward. But if I say it all the time, right, then we have open, honest dialogue. And I'm looking to prove to myself that this team is willing to criticize each other, willing to understand each other's strengths and weaknesses, which, by the way, we all have. When I grow a beard, it is silly looking, right? We all have our weaknesses, right? And you want to sort of get through that at the team level. I mean, a lot of times we ask them to say, in 10 years, what does the world look like because of your company? It's that vision that they can articulate, the very clear end result. They don't care at all about the product, but they care about the impact of the product, right? If you talk to MakerBot, for example, they would tell you, well, in 10 years, everybody will print whatever they need at home, right? They won't say there'll be a MakerBot 3, right, that's this big and whatever. Like, they'll accomplish that however they need to accomplish it, right? They're not tied to the product or the solution. They're tied to the vision and the problem. So we look for that.
Awesome. And no offense taken, I'll just apply to an accelerator that likes my beard. That's all.
Yeah, I mean, it's an easy problem to fix, right?
You heard it here first. Techstars does not like beards.
Not true.
Cool. So broadening the questions a little bit, not just about Techstars, but sort of about investing in entrepreneurship in general. I thought this one was interesting. This was emailed in. So in the current environment where it's arguably easier to raise money at an inflated valuation than has sometimes been in the past, how should entrepreneurs think about the temptation to raise money too soon or before they've really hit product market fit?
Yeah, that's a very good topic for today. I mean, I've been using the phrase it's summer for startups, right? It's just good times. And these things come and go, and the market will turn at some point. But right now, you're right. I mean, there's more capital in the market, particularly for seed investment, than there has been in some time. In 2014, we raised a fund last year. There were more venture dollars raised in 2014 than in any previous year, right? And so what's interesting is there's now 4 times the amount of seed capital available, right, than there was a few years ago, and there is 1 time the amount of Series A capital available, right? So the Series A capital has not grown tremendously, but the seed capital has, which means it's easy to raise money. When it's easy to raise money, valuations go up, right? And the temptation is, well, I was going to raise $1 million at $4 million pre-money, but if I can raise $2 million at $10 million pre-money, why not, right? And I think the way you phrased it is actually really good, which is, how do I think about that? Is that a temptation or is that a good thing? I would say raising more money is generally a good thing because it's more fuel for your company. The potentially bad thing is raising that money at too high of a valuation. Okay, so because the market is speaking, you may say, well, I'm going to take money from these unknown people because they're offering me $10 million pre, right, instead of $4 million pre-money, because I'm focused on price and I'm focused on dilution for myself. I want to own the most of the company. That may be a huge mistake in a couple of dimensions. One, you may not be getting the best investor. The best investor might have added more value and might have helped the company grow or exit or whatever. And believe me, I've seen plenty of investors double and triple exit values in a day, right? Helping companies negotiate the exit. So there's real value in who your investors are. At the same time, you're setting the bar for the next round even higher. So if you're raising $2 million on 10 pre when you have an idea, now you're going to need to raise your next round on 15 or 20 pre, potentially when the market is down, when you don't have that kind of progress, and when there's not the same multiple of Series A capital available for you, right? So the expectation you create for momentum is an up round in the next round. Much easier to have an up round at 6 or 8 million than at 12, right? Twice as easy, right? So those are some of the problems that you set up. My advice is raise more money from the most value-added investors if you can, but be cognizant of the right pricing for your company at the right time in terms of the valuation, because it's a hard thing to keep up with and live up to, and it makes the next rounds very hard. And I'll tell you a story. I always come back to Uber because everybody knows it, and I apologize for the humble brag. But in the angel round of Uber, I won't tell you the exact pre-money, but it was sub $5 million. Okay, and it was $1.5 million round. You can probably go look up the facts. I mean, you know, today Uber would probably be able to command, you know, 10, 15 million based on who's involved before they even had an idea or before they even had a product, right? They weren't worried about it. I distinctly remember this. I mean, Travis and Garrett were well known. And they're like, hey, let's get a good diverse group of angel investors who are going to help us launch in different markets. Let's get them to be geographically diverse. That's going to matter to us. Let's get ones that have, you know, shown that they help companies. And they did it at some totally reasonable sub $5 million pre-money valuation. I can tell you they are quite happy with the outcome, right? This has not been a problem for them. They sold a big chunk of the company early on, right? But as they grew, you all have been reading about how they're raising billions of dollars at, you know, 18, 40 billion valuations, taking hardly any dilution. And oh, by the way, easily taking money off the table if they want to, right? And so the first round is not the only round that matters, right? In fact, hopefully it matters the least. And what you want to do is you want to motivate your investors to help as much as possible by owning a real chunk of the company, right? So it's a very real lesson in how to construct capital formation without, you know, sort of caving into the opportunity to raise at much higher prices than you're actually worth today.
Awesome. Thanks for that. Sort of on that just reminded me, does Techstars ever continue to join future rounds of companies that they originally sort of found in the accelerator?
We do. So we fund, our capital is targeted at the Techstars ecosystem, and we have about $280 million under management in the ecosystem. The latest fund's $150 million. We target the ecosystem, which means companies going through the accelerators, which we've been talking about, of which there are about 200 a year, right, that we might target to continue falling on in. But importantly, it's also companies founded by our alumni, right? So we have, you know, 1,000, 1,500, whatever it is, alumni now who've been through Techstars 6, 7, 8 years ago. They're now starting their next companies. That's part of our network and part of our targeting for our capital, because we know those people, right? And also the mentors. There are now 2,000 mentors across the Techstars system, right? And that's actually the story of Uber, right? Ryan was here in Boulder mentoring on his way to California. And that's how we became aware of the company, and we invested in a company that someone was giving first to Techstars and mentoring our companies. So we do follow on. We do the accelerator investment. We typically do $300,000 investments post-accelerator and sort of $1 to $2 million Series A investments, generally as a co-investor. So we're generally not leading those rounds, but sort of following on with more capital. So we have the ability to go all the way through the A round.
Awesome. Getting some good questions popping into the group chat here. So, Sergey, in searching for a co-founder, do you have any suggestions regarding negotiating terms of ownership? For example, if there's two of us, I'm a designer and PM, she's an engineer, should I automatically offer her 50%? In addition, what if she's a junior engineer? How have companies you advised worked that out?
Yeah, so the most important concept for people to understand here is the concept of vesting. And if you really understand the concept of vesting, it sort of informs how you think about this. If you don't, I think you think about it in lots of weird ways. The idea of vesting is that I'm going to bring somebody in that I think is my equal. If they're not my equal, I have the ability to get rid of them, and their ownership has not fully vested, right? So what's typical is you'd say, okay, we have a 4-year vesting schedule. You get 25% of your ownership after 1 year, and you get 1/36 of your ownership every month thereafter. Right? So after 4 years, you actually own that 50% or 30% or whatever you've given them. So what you want to do is you want to bring somebody in that you're so excited about that you expect them to be worth that much. right? And once you sort of have that mindset and you know that you can get rid of them if they're not living up to that standard, it's easier to say, well, I view them as an equal if they, sort of are everything I think they are, and if they are wholly into this with me. I might want to give them 50%, but 6 months in, if I let them go, they get nothing. And the best people who want to join you are willing to take that risk, right? Because this is a high potential startup. They've got to perform in it, right? They've got to live up to the expectation. Now, as far as once you understand investing, that helps, right? As far as what percentage you can give them, I can't answer the question for you. It's all over the map. A lot of people who are just starting out will say, I'm going to make everybody equal because the dynamic is worth it. I have the control to get rid of people that aren't performing, right, if they were the original founder, and you do that through vesting. A lot of people will say, look, when I brought in partners, right, I retained most of the ownership of Techstars. Why? Because it was already pretty valuable at that point, right? So only you and the people you're negotiating with that you're bringing in can really answer that question. But vesting is the tool that you want to make sure you're using in any case to make sure that they're worth every bit of what you gave them.
Cool. This is an interesting question. Shaitan just threw in, what if I have an idea, solves a problem, but the technology isn't necessarily available today to address it? What are the chances to get funding to start experimenting with like a longer term problem like that? Do you have any companies where it's a really far down the line problem?
Absolutely. I mean, if you think about companies like SpaceX, right, or Tesla, or any pharmaceutical drug, right, the cure to cancer, certainly people invest in these things. Right? I mean, I think it's a potentially huge payoff with a much longer horizon, and so you're maybe looking for an investor with that mindset. But a lot of the things we work on are software oriented. They're pretty quick to get to the market. There's this idea that some people say, hey, accelerators only fund these like derivative small ideas, right? You need to fund more big ideas. I call absolute BS on that, and the reason is because everything starts small. Right? There's very few companies that start with, we're going to go land on the moon. Right? Most companies start with, like Microsoft, we're going to measure traffic going across the road. Right? That's the origin story of Microsoft. We're going to have a little box that measures traffic. Oh yeah, and then we're going to have this idea for Visual Basic. Oh yeah, and then we're going to make sure there's a computer on every desktop. Right? Like that evolved. It was not the origin story of the company, and that's typically true. So I think I'd say two things about this. Yes, it exists. It's probably harder to find. People have to have that same vision. They have to have the conviction that you're right and that you can go accomplish it. But I think at the same time, back to what I said earlier, be in love with the problem and solving it and not the solution using that technology. Are there ways that you can make that thing better now, right, with a different solution on the road to waiting for the rest of the technology in the world to catch up to you?
Yeah, that's probably another great example of why the team is so critical, because the solution idea is going to pivot so many times. So we had a bunch of questions. So the Code Mentor audience is pretty international. A lot of questions about startup projects starting in other countries, ones that don't have Techstars currently, and people who are thinking of moving to the US to try to join something like Techstars. Is the process any different for them? Does the focus need to be any different for them? Is it pretty equal playing field?
It's pretty equal. So first of all, Techstars is expanding internationally. We do operate in London. We have a couple programs there. We have a couple programs in Berlin. We will be announcing more stuff soon internationally. So we have global aspirations. So hang tight, we're coming. We're going to help communities all around the world sort of strengthen their startup communities and provide more early stage opportunities for people, because we know great entrepreneurs are all over the world. As far as coming to the US, same process. We've been historically about 15% of what we funded in our accelerators are companies coming from outside the US. It's 100% fine. It happens all the time. We love it. In fact, we recruit actively in many parts of the world. We have managing directors traveling in many parts of the world all the time. So look at our events on our website and stuff to see when those are. But you apply the same way. You do have to be here legally. It is 3 months long, which is coincidentally the duration of a typical tourist visa. Right? So you're able to be here without a job. You're your own job, right? There's nothing that stops us from funding you. So we do it quite regularly. and we're looking to solve it in two ways. One, have more Techstars around the world, and two, make it just as easy to apply and come to the U.S. Of course, we have lots of immigration issues here in the U.S. Many of us are very active working on making those laws better to allow entrepreneurs to come here and hire people here, which seems like a no-brainer, but it's a complex issue. So hopefully some of that helps understand how we deal with it internationally.
Great. So this question's definitely a little bit sensitive, but I think it's an important one, and would like your opinion on it. Someone wrote in, that there's quite obviously a lack of diversity, from Latin American and African Americans in tech, especially on the developer and engineering side. What do you recommend teams can do to try to just include more diversity in the tech startup world?
Yeah, I don't think it's a sensitive issue. I think it's an important issue, right? Obviously our whole community is talking about this. It's a huge problem. There is a sort of supply and demand issue, right? I mean, we need more people who come from diverse backgrounds, interested in entrepreneurship and sort of internet technologies. There's plenty out there, and we don't do a good enough job addressing it, that's for sure. Techstars has done a few things that I hope are going to be impactful. One is we started a program quietly called Rising Stars, where we take our 1,500 or so alumni, make them a mentor to an underrepresented group of entrepreneurs. So be that military veterans, women, African American, what have you, and try to do one-on-one mentorship to help them understand where the bar is. I think we're rolling that out. We have about 80 or so of our alumni actively doing that. Some of those companies have gotten to other accelerators, things like Numi, a group called Pigeonly that we mentored for a year that ended up in the Numi accelerator and then raised a few $1 million. Awesome group of people that we were able to help get some exposure for. I think we need to make heroes of the people that don't look like most of us, right? We need to blog about them more. We need to interview them more. We need to show that it does happen and that they can inspire others. And then I think, lastly, we all need to be conscious of this, and we need to measure our own data. So Techstars is engaged in an active process to look at all of the founders we've ever funded and try to understand. We don't ask those questions on applications, so we don't actually have the data sitting around. We're going back and trying to get it. We'll then publish it, and then we'll track it over time. So you can't improve what you don't measure. I think we're doing really well with female entrepreneurship. We have lots of female CEOs, people like Payal that run ClassPass in New York. Lots of great female CEOs, but I think the rest of the diversity issue we need to address much better than we have, and we're focused on it. And as a community, I think make heroes of the people that don't look like most people that are doing this, right, or come from diverse backgrounds. Like, let's all promote them because that's what gets more people to do it. Let's look at our own ratios. Techstars, for example, took a hard look at our mentor ratios, right? What are we putting up on our website? We've been actively adding lots of people that they're out there. They're easy to go find. We just need to do it consciously, and we need to talk about it. So I'm really glad you brought it up.
Thanks so much. Yeah. A couple questions about protecting ideas. So what do you find is the best way to protect the idea and setup of something, whether that's patents? I don't know how early or late stage this person is thinking of, but yeah, do you get this question from your companies?
Yeah, I mean, protecting your IP at various levels. Look, I'm an investor in software where you're shipping, bits and bytes around for the most part, right? I think there are different answers when you're, again, inventing a pharmaceutical drug, or you're curing cancer, or you have a piece of hardware that truly does something special and different. I think patents are great for that. I think patents in the software world are a mess. I don't think startups should worry about them, generally speaking. And I think when they do, they should use them only defensively and not offensively. The Twitter innovators patent sort of model is brilliant in that it causes the companies that acquire these patent portfolios to guarantee or promise that they won't use them offensively, and that they never would use them without the permission of the actual inventor who sold it and sold it and sold it to other groups, right? Because they want to go with the intent of the patent creator. And the intent is not to stifle innovation. The intent is to protect something that's truly an invention. And in software, we don't have a lot of that, right? And so I find software patents to, on some level, just be kind of a waste of time. Now, it's also the sport of kings. You can't win it unless you have a bunch of money, right? You're not going to beat Microsoft in a patent dispute, right, as a startup. So you need to find ways to win that don't rely on IP in the software world. I tell people, don't worry too much about patents. It's not a question I ask as an investor. You don't have the money to win that game anyway. If it's truly unique, go ahead and get yourself a patent, probably get a provisional patent first, right? If it's truly a physical thing or some chemical formula that is super hard to figure out, I get it. But in software, I mean, we're doing math and we're displaying stuff on a screen. It's really probably not worth patenting.
Awesome. Yeah, it's worth checking out. If Arthur, you should check out how Tesla recently open sourced their stuff and the stock price went up actually, which I loved.
Give first, right? I mean, here, if you can copy it and do it better than us, we'd rather see that happen than us do a crappy job of it. We want this to be out there. And the same thing we did. We open sourced the accelerator model through the Global Accelerator Network, right? We still think we do it better than other people, but we want to help more entrepreneurs, right? That's what we're all about.
Totally. So this is a good one. This is just about motivation in general. So someone mentioned, working on their project and tending to lose motivation now and then, but it coming back. What type of advice do you give to your companies? Do you see that more as an indicator of losing passion about the specific problem, or is it just part of the process?
So sorry, repeat the first part of the question, like the gist of the question.
So Shaitan wrote in, I tend to divert from my problem statement and lose the motivation every now and then. What tips would you give to keep oneself motivated throughout the journey?
Got it. Okay, I see it on the sidebar. So I'm going to randomly answer a different question because I like to do that sometimes.
Okay.
I see Arthur's follow-up question. I want to answer it. So in the case to review and approve credit, it's better to just build it and hope no one pays attention. So he's talking about the patenting thing. Yeah, I think execution trumps a patent. Right, I really do. I think you might protect your secret sauce, right? You might not tell others how it works. Again, it probably could be copied easy if somebody saw it, right? It's not rocket science, I'm guessing. Maybe it is. I see your face. But yeah, I would execute, and I would do the best job of delivering that thing, and I would recognize I'm not going to beat people because of the patent. Back to your question. I get diverted from my problem statement and lose motivation every now and then. All right, this is interesting because I get asked a lot, when should I quit? Right? When should I give up? And I think when you're having multiple rough days in a row, when you go outside, and like I did in the first company, I literally punched a wall and I hurt my hand doing it. I was so frustrated, and I would go in the stairwell and I would yell. I'd be like, oh, I hate these customers or whatever. Recognize that is just building a startup. Don't quit, right? That's part of it. Frustration, anger, like emotion. It takes a lot of getting through that stuff. That's right. But you know when to quit when you just don't have the passion anymore. It's fading. You're not doing it for the right reasons. You have lots of days like that and not very many good days in between, right? Because it should be highs and lows. That's normal. Right? But when it's all lows, and when you can't motivate yourself to go work on the thing, it's coming from the wrong place. It's coming from here, the head, and not here, the heart. Right? And I think that's opportunity cost. We only live once, I think, and we only have a certain amount of projects in us. So let's really focus on the things that get us out of bed and get us motivated, and we don't need external motivation. And you will find that you're more successful doing what you love, even if it doesn't seem like as big of an idea. So when you're losing that motivation, ask yourself why that is, right? And if it's because you just don't care enough, that's probably not a startup. That's probably a job.
Awesome. We got a question in from the other room. Let's see. Gordon sent a question. We launched our software. So this is a question about a company that is doing, things are going well, we've gotten some good traction with key clients. At that point, should we start prioritizing on funding, assuming they haven't raised any money yet, or just continued engagement? To me, I'm going to change the question a little bit. To me, this is a question about because funding sometimes is different for everybody. Sometimes it's out of survival, it's out of just getting started. But if things are going well, what's a good way to think about funding at that point? Is it because you're dreaming even bigger, or just to have a war chest ready? What do you recommend in a situation like that?
Yeah, so I guess the meta question, right, is should I raise money, right? I've got a thing that works. Maybe I've got some customers. Look, so there's many ways to finance a company to get bigger and to grow. One way is through this thing called revenue. Many people forget about it. I'm a huge fan. I find it very sexy when you have revenue. You actually may not even need to raise money. So let me tell you a quick story about my first company. We raised $100,000 ever. Right? It's now about a $50–60 million a year business. It's part of a public company. $100,000 in financing was all we needed. We literally needed to keep 3 people alive for a year, and we paid ourselves, you got it, $33,000 a year. That was it. Right? It was enough to survive. We were bootstrappers. Right? That company did not need to raise money. It was selling a product to a market that was willing to pay for it. And I will tell you, it's a very lovely feeling to own 100% of your company at exit. Right? And so the first question is, should I raise money? Do I need to raise money? Not, oh, I'm going to go raise money because I'm doing a startup. That doesn't make any sense. Right? So the right thing at the right time. If you can bootstrap, if you can build it on revenue, you should. Right? There are other ways to finance a company. I had a company where same company, we sold that $100,000 product to a customer who paid us $100,000 before the product existed. That was the money we raised. Our deal with them was, we'll pay you back that money, and you'll get to use our software free forever, and we'll pay you 2.5% of whatever we sell in the future, gross. Okay, so that was their upside. That was our financing. That was a 20x for them. Right? We eventually paid them back $2 million. That number was going to be a lot bigger, but we negotiated it to $2 million. So forever royalties are a bad idea. You should try to cap them. And we had to do that while we were exiting. We had to say, look, guys, you have a 2.5% royalty. The acquirer doesn't want it. Right? So will you just let us buy that out for $2 million? And they said yes. Right? Which is very nice. They didn't have to. There are other ways to finance your company, is my point. Customers are a great way. Royalty-based financing, a great way. Then you get to angels and venture capitalists, which are an expensive way to finance your company, right? By comparison. So first question is, should I? Okay, let's say that I don't have the money to continue doing this. The company's going to die. I'm not anywhere near revenues. Maybe I'm working on a consumer-facing product on the internet that's going to take me a huge audience before I have any money coming in. I can't really monetize it early on. Yeah, probably a target for venture capital or angel capital, right? At that point, I think it's this idea of, how do I get to the next meaningful milestone with this company? Building a consumer company, how do I get 100,000 users, right? Building a enterprise software company, how do I get 3 lighthouse or pilot customers, right, that I can reference? That's a meaningful milestone. I need enough capital to do that and no more. So many people go out to the market and they over-ask. They'll walk into my office and say, David, I'm raising $5 million, and I'll be like, oh, cool, I don't do that, right? You should go talk to these other people, right? And they don't really need that much money. They just think that's what they're supposed to do, right? And so raising $500,000 or $750K or whatever might be plenty of money to get to the next milestone. So just be conscious about what it is and what you need to get there, because the over-ask is the killer, and it's also a killer in terms of your own ownership, dilution profile in the company.
That's a great story, that first fundraise. Thanks. Well, guys, we're down to like our last 10 minutes, so throw any remaining questions you have in. One I definitely wanted to ask you was, what books, blogs, general resources do you tell all of your entrepreneurs to read?
Oh, well, this is an amazing book called Do More Faster. Thank you for asking.
Oh, yes.
Which is the lessons we learned around Techstars, so hopefully you check that out. I like to read books also from outside the space, right? I think we get really hung up on kind of the conventional wisdom in the startup world. There's obviously plenty of great books. Brad Feld has written a ton of awesome books like Venture Deals that are very specific to financings or startup communities about how these things function in our communities. I think some of my favorites are sort of more like Zen in the art of motorcycle maintenance, right? It's that how do I keep my vision, keep my composure when things go wrong, which they inevitably will. It's not about startups. It's really a metaphor for startups or for life to me, or entrepreneurship. And then one book that impacted me very, very heavily is a book called The Soul of Money. And it gets to the why. Why are we all doing this? Are we just collecting credits in a bank somewhere? Or are we trying to impact the world? And I believe the money follows the good intention. And I'll tell a quick story, part of what's in The Soul of Money, but it comes from one of my favorite mentors, Bill Warner in Boston. He built Avid, which is if you've ever edited a video, you've used the time sequencing. That's Bill. He created all that. Great angel investor in Boston. He told me, when I was early in Techstars, he said, you have an amazing center flow, right? That center flow is not going to generate any money. Right? He said, you're trying to help entrepreneurs. You're giving first. You're running these accelerators. That's cute, right? But it's not going to be a scalable, huge thing. But you have to keep doing it because people feel the passion and they feel the reasons that you're doing it, and you're going to have co-flows alongside your center flow. As long as you focus on the center, you're going to have opportunities that come along, right? And to me, those have been corporate accelerators. We run the Disney accelerator, we run the Nike accelerator, run the Ford accelerator, run the Barclays accelerator. Those have been huge opportunities for us. We manage venture funds. That never occurred to me when I started accelerators. It was never the goal. These are the co-flows that came along. But if you killed the center flow, that passion, right, and the reason you're doing it, the other things would disappear, right? And so the Soul of Money teaches us to focus on what we actually care about, and how we spend our money and how we use our resources in this world really represent who we are. And I was very sort of motivated by that. So I think it's a great book. Thanks for listing them in the comments there for people.
Yeah, that's great. I'm writing that one down for myself, Soul of Money. How important is it to have a mentor for your startup? So we covered mentorship quite a bit. Welcome to chime in on that.
I'll tell you what, people like stories. I'll tell you another quick story.
Yeah.
The first company that ever sold that was a Techstars company was called Social Thing. He was in Techstars, so obviously he had mentors. One of them was this guy named Brad Feld. Brad negotiated the exit of Social Thing to AOL. He got on the phone. I think it was a 30-minute call. And I think they sold it for twice as much as what Matt was willing to accept and what the first offer was. So Matt was like, oh, got it, I'm out, right? Brad got on the phone, and 30 minutes later, a very significant multi-million-dollar figure doubled. So what is the value of a mentor? Potentially that, right? I have another story about a Techstars company that was in our New York program that asked people in the program if they knew that anyone that they could talk to at Victoria's Secret. Promptly, the mentor took that entrepreneur, got on a private jet, flew them to a private lunch with the CEO of Victoria's Secret. Right? So network is everything. It can be the difference between success and failure. You've felt that in a lot of your interactions, who you can sort of get a favor from here and there, or get advice from here and there. Hugely important. I can't overstate it. It's just surround yourself with people that have network and can open doors for you and can get you a meeting is really important. Yeah, Arthur said it best. Pretty damn important.
Do mentors get a cut of the final sale of the business?
Not unless you give it to them. I define mentor differently than advisor. I think advisors ask for options or part of the company. Mentors give first and only take that if you offer it. Right? Investors invest money in exchange for equity. So if someone comes up to you and says, well, I'll help you, but only if you give me equity, I think it's a bit of a red flag. Right? What I would say is I'll help you by either investing or just by being helpful. And if you want to give me something, fantastic, but I'm not asking for it. Those are the best mentors. So keeping that definition in mind is really important. There are a lot of people out there who will say, I'll help you raise money for 10% of what you raise. People like me who get in contact with those people have allergic reactions. We don't want to deal with them. it's fake, it's not really you, you're willing to outsource that to somebody, right? Like, it's fine to take advice, but paying for advice before the value has been delivered, I think is not necessary.
Awesome. Well, I think probably the last question, because I don't want to take too much more of your time. This has been amazing, but one of the last things I wanted to cover was, one of the things that I think Techstars does very clearly different than other very largely publicized accelerators that are focused on Silicon Valley or New York or specific hubs, is you guys are very community based and in all these different locations. I mean, how is that, like on the ground in a place like Boulder? How has Techstars kind of changed the landscape of the startup scene in a town like that?
Well, hopefully we've contributed to the development of it, right, in some way. I mean, I think certainly we've helped attract people to the community. We've supported them when they've come here. We've attracted more capital, I think, by forming our own capital and putting money in. We've attracted more capital from the coasts primarily, and I think we have super connectors now in the community that are sort of known and can sort of call up Bessemer or Union Square or whoever and say, hey, I want to do a deal with you. So that helps the community here. But you're right, that's really, I think, hopefully what sets us apart is we're building, again, this global ecosystem that I started the conversation with. We're not about any one place. We're about the idea that you can build great startups anywhere. We're not in any way, shape, or form anti-Silicon Valley. We're just pro everywhere else, right? I mean, that's our attitude, right? We believe that there are plenty of great places in the world that awesome startups are going to come from. And if you don't believe that, you're not looking at the data, right? Name a city, I'll tell you an awesome startup, right? I mean, they're there. Companies going public. We had a company here go public, right, recently. Rally, right? Never heard of a good startup in Chicago? What about Groupon? Right? I mean, there's tons, right? And so it's silly that you have to go somewhere. If you want to go somewhere, go. I love being in Silicon Valley and raising my hand and asking people, hey, if you're from here, can you raise your hand? And it's usually 5%. So they're coming from somewhere, and our goal is to support them where they want to be, not where they feel like they have to be.
Awesome. Well, David, where should people follow your work the best? I know you're blogging, you're tweeting. What's the first target people should go to?
I think Techstars.com, is a wealth of information. We're actually launching a totally new site there in the next month or so. My personal site is David G. Cohen, G like Gregory, my middle name, .com, and that's where my blog is and stuff. And then Twitter is just David Cohen. So, and I always encourage people to reach out. I answer all my email. My email is david@techstars.com. I'm very happy to answer email from anybody that needs help.
Awesome. Well, thank you so much again for your time. Thank you, everyone, for joining. Please, actually, I wanted to remember there's a Techstars deadline today. So if any of you were working on applications, you can still get it in today, I believe. And CodeMentor is actually a Techstars company, if we didn't mention it earlier. So they've been wonderful. Please check out more CodeMentor's office hours coming up. We have a bunch of great more sessions in our JavaScript framework series coming up, different from this one. But hopefully everyone got a lot out of this. And I'll be sending an email to everyone who RSVP'd with some links to a bunch of stuff that David talked about. So if you didn't jot everything down, hopefully I'll get that to you in an email in the next day or so. So with that, I'll say good afternoon, good morning, good evening, wherever you are in the world, and thanks so much.
See ya.